Hi, this is Hyperwave. I'm Leah Wald. Obviously, we have Tyler Jenks here, and it's about to rain. Pigeons are copulating in the streets, and all hell is breaking loose. But at least I have a really cool sweater. Thank you to Crypto Stoic, and we're going to talk about a lot of really interesting things. Obviously, to start off with more morose news, the Dow has actually erased all of 2018 gains. NASDAQ has actually posted the worst day since 2011. But again, I have a really cool sweater. Thank you guys so much at Stoic Crypto. So with that said, let's just, jump right into it and shill our own stuff first. Hi, guys. Hope you're having a nice day while I pull this up. Ooh, boom. Boom bada, as Tyler likes to say. Okay, so if I don't have it up, yeah, it is a nice sweater, right, guys? Okay, so we and Tyler is about to talk about it, are going to do our second webinar, and we're even better at TradingView now. So Tyler, I'll let you explain this. It's up on screen share.
Okay, terrific. Hello, everybody. I wanted to talk about this before I get into the grim news about the market, and we look at a bunch of charts, and we're going to talk a little bit about Bitcoin. But we really didn't plan this, knowing what was about to happen. I don't mean just in the markets, but politically. But the name of this, we've changed this around a little bit, and we're going to talk about portfolios. That's the subject matter here. But we're going to talk about portfolios very specifically in terms of the difference between random portfolios and pre-constructed. A pre-constructed portfolio is either a closed-end fund, an open-end fund, an exchange-traded fund. It isn't such things as a hedge fund, because a hedge fund is constantly changing and taking both sides of positions, and you never know what they're doing. So I want to go into that in a lot of detail, including making it very relevant to how you protect each of these types of portfolios using defensive measures, because we're going to talk in the last hour about the current situation and how various portfolios work in that situation. A portfolio can be negative, meaning it does well when markets are going down. It can be very positive when markets are going up. It can be a combination of both of them. It can be defensive because you've put a lot of bonds in place of stocks. You can have inverse ETFs and inverse funds. But I will explain what I mean by random versus pre-constructed, because what most people end up doing is buying this stock and then that stock and then this stock. And over time, they have built a random portfolio. And they don't really understand what it is that they have. And then they'll throw in a couple of mutual funds and some ETFs. That's what the entire 3 hours is going to be about. So it's very clear to everybody how and when you use either random or pre-constructed portfolios to achieve different objectives, regardless of what they are. Sending your kids to college, so you do a 529 that has certain kinds of portfolios you can buy. Those are pre-constructed portfolios. And we're going to talk about GBTC because it doesn't actually end up in one of these things. It's closest to an a closed-end fund or an exchange-traded fund, but we'll explain why and how and what the benefits of all of those are. At the end of this show, we're going to just go kind of day by or hour by hour what exactly we're going to cover. We won't do that right now because we want to get right into what's going on. So thank you for bringing that up, Leah. And for those of you that read a couple of the tweets that I just, yeah, Leah, I'm sorry. Show people or tell people exactly what this thing is.
this be a contact form. Yeah, so right on Lucid Funds. So our website, nice and easy. Bada bing, bada boom. Information, and fill it out, and I will actually get right back to you. So it's as simple as that. And if you guys have any questions, definitely you can write in the message area. But it's nice and simple, and everything's above. So okay, last shill. Thank you so much. This is Stoic Crypto who made this shirt. Okay, I'm done shilling. Tyler, make us brilliant.
Great. I tweeted out a little while ago saying that hell hath no fury like two political parties locked in mortal combat. And you've heard me for the last 3 weeks saying, as we have been cautioning people about what was going on in the marketplace, that what was going on had nothing to do with economics or the stock market or earnings or GDP growth. It had to do with something else, which was political. And today, unfortunately, was the culmination of what we have been seeing building ever since the Kavanaugh hearings. And I've been saying that I have been very worried about the effect that all of this acrimony is having on the confidence level of people in the markets. And that this election coming up 3 days after our conference on portfolios is, in my mind, the single most important midterm election and possibly election in my lifetime, even though it's not a presidential election. And the reason I said that, I tried to make clear it wasn't a political statement. It was a statement about what I was seeing in our markets. And this comment that I made today about the two political parties in mortal combat obviously had to do with this horrible news today about all these pipe bombs. And I wanted to just give you a little bit of perspective on that in my mind, because it's been building for the last 3 weeks. It started with people spitting on other human beings in elevators, in Congress, in the official buildings, in the Judiciary Committee, people screaming, turning red in their face. Then it progressed to the point where people walking in malls, in restaurants, in public places were being hounded by people screaming at them, shaming them for who they were and what they stood for. And then today it basically took the ultimate turn and became deadly, with pipe bombs starting with going to George Soros, and then today to the Obamas, the Clintons, CNN up in New York, John Brennan, the ex-CIA director. All of these had return addresses of Debbie Wasserman Schultz, the former Democratic National Committee chairman. They also went out to Eric Holder, Obama's attorney general, Maxine Waters, and even Andrew Cuomo thought he got one. It turned out that he didn't. But what my point is I have said that the two parties have become insane, and they are locked in this combat where no one will discuss anything civil with the other side. And that's happened before in history, but it has not happened at a point in time where the stock market and the economy has been doing so well. And at first I thought I was just making excuses for the fact that the technicals were not picking up the potential for this 10-year bull market to come to a screaming halt over nothing economic, nothing financial, until we've had the culmination of this nonsense today. Now, what happens tomorrow and in the next 10 days, I have no idea. but we've changed our entire webinar structure into a very clear explanation of all of our previous vlogs put together, having to do with money management, having to do with options, ETFs, mutual funds, all of my adages. Don't tell me what to buy, tell me when to buy it. The trend is your friend. The Consensio information, the Hyperwave information, all of that put together. When you use some of it or all of it, what you're doing is building a portfolio. To our consulting clients, I'm trying to help you build a portfolio. Or if you've had a portfolio, to change it in ways that are easy to initiate and implement, and to be able to make those decisions yourself using certain tools like Consensio. All of those hours and hours and hours and hours of vlogs and tweets I've put together into, I believe, a 3-hour presentation plus an hour worth of questions and answers, as specifically as everybody wants them. Now, I'm about to turn to the charts because what everybody wants to hear about is exactly what damage was done today, where, when, and how, and what recommendations I would make for people to consider about what all this means. And then as we get closer and closer to the November 3rd seminar, we are going to do this every day, meaning a vlog like this at the end of the day, summarizing what we have seen relative to everything we've said in the previous vlogs right up to that day. And that will help those that join us in the seminar on November the 3rd to have a real understanding and perspective on why I've been doing certain things in terms of raising cash, using Consensio, putting on inverse positions in certain areas of your portfolio, but not in other areas. So what we're going to do today is I'm going to screen share, and we are going to go through the same basic charts we looked at yesterday, which were, first of all, the indexes. Let's see exactly what happened today. You've heard the numbers. They're big and they're bad. And then we're going to take a look at the sectors. And then we're going to take a look at a number of individual stocks. Now, all three of those things, indexes, sectors and industries, and individual securities, when put together in one form or another, become a portfolio. And that portfolio takes on characteristics by what you have added to it or taken from it. It is not static. It also takes on characteristics, if you don't touch it, by what the markets are doing. Things that weren't risky become risky. Things that you thought were conservative become risky. Things that were very risky all of a sudden become conservative, and you haven't touched a thing. So that's the kind of analytics we're going to go through. Now, just to give you an idea of what I'm talking about, if everyone that listens to this vlog, and I'm asking you to do this because Leah loves to get hundreds of messages, I would like everybody to pick out one stock, just one stock. Doesn't matter what it is. It doesn't matter if you love it or if you hate it. Just pick out a stock and send the name of that stock to us. And we're going to take all of those at random. Anytime there's the same stock, if 3 people pick Tesla, we're only going to use Tesla once. But we're going to take randomly the names of the stocks you give us, and we're going to build a portfolio. And then I'm going to analyze that portfolio on November the 3rd. And I will tell you what that random portfolio looks like compared to mutual funds, ETFs, and indexes, to make a lot of points that will become clear in the seminar. Okay, with that, And Leah, where should I have them send this to you?
You're in so much trouble after the show, Tyler.
Sorry.
No, it's good. Everybody, I see you in the live chat. There's no way I'm gonna be able to copy and paste all
Yeah.
this really quickly.
And we don't need names. We don't need anything. Just all we need is the name of a stock, just a stock.
Yep.
And just for giggles, let I was going to say let's make it just U.S. stocks, but that's not fair because we've got a lot of international viewers. If your international viewers know of any U.S. stocks, try to do that. So my analysis is a little quicker. Okay, where should they send these, Leah?
Exactly. Okay. So yes, I can do it. Thank you. I can. Okay. So when you guys fill out the contact form for the webinar, then yes, please put it there. So in the comment section, just say I'm seeing a lot of Apple and Netflix. So Apple, Netflix, etc. in the contact form when you sign up for the webinar. And yes, I will. This is. I like challenges. I'm in. All right.
Okay, great. I'm going to screen share. I'm going to this. I'm going to this. I'm
Not doing Ripple, guys.
this. I'm going to this. Oh, actually, they could do that. If you want to put in a crypto, that's okay.
Tyler.
Okay, here we go. I am going to start, as I said, with the indexes. And we're going to start with the Dow Jones Industrial, which lost 600 points today. And we're looking at a chart that I'm going to take it back a little bit this way to the beginning of 2018 so I can see everything very clearly. All right. We now have price below everything. We now have the short-term index, the short-term moving average cut through the intermediate and also cut through at the close today, although it's not a week, the closing price for a week. It's only Wednesday. We've got 2 more days to go. It could pop back up. But we do not have the intermediate yet below. The Dow in this position requires a 50% cash position. We were at 25. First, we started at 5, then we did our 5, 5, 5, then we did a 10 up to 25. And now I'm saying that because of this action today, which pulled everything else down sharply, we would be in a 50% position. Now, you can wait until Friday on the close to make that decision. But in any case, I would be thinking of at least another 10 to 15% above the 25 in cash if you've got Dow or Dow-like index positions in your portfolios. Let's take a look at the S&P. The S&P is worse because the entire candle on the far right is below the long-term moving average, which has not yet turned down. Going back to the Dow long-term moving average has not, nor will it turn down. That's the last piece to go 100%, and that will be nowhere in the near-term future unless these bars come down here very, very quickly, which I will talk about later. I'm not expecting. I think this particular sell-off is about over, but you never put your opinions, such as the one I just gave, in place of what Consensia was telling you the market as of 4 o'clock today told you. You always go with the evidence, not with your emotions, not with fear or greed, and not with your opinions of politics or what you think is going to happen tomorrow or the next day. You just let this dictate your movements. Okay, so back to the S&P. The S&P then is also in a 50% kind of a position, not until the end of the week, but you can see where it is. It will take a tremendous move to get these things back up above their long-term moving averages. Now, the earnings are coming in after the close today, and some of them are very, very good, and some of them are not, like Advanced Micro. Tesla had blowout numbers and is up 12 or 13% after hours. Many other things are not doing so well, but this is the kind of thing you get in this season anyway, without all of the political turmoil and all of these other previous 4 weeks of sell-offs. Let's take a look at the NDX, which was down 4.6% today. And when you take a look at this compared to yesterday, where it was looking reasonable, this NASDAQ 100, today the entire body of the candle is below the long-term moving average, just like in the other ones. We do not yet have the intermediate cutting through the long term, but it's coming down very sharply. This is, again, a 50% sort of a position. IXIC, which is the NASDAQ composite, we already said yesterday that that entire body of the candle here was below the long-term moving average. And now we've got a huge candle below not only yesterday, but the short-term moving average couldn't even keep up with it. It was dropping so quickly. Remember, on the short-term moving average, it's designed time-wise to always be touching the movements. And now we're breaking away from it. It will catch up tomorrow, but that's how extreme this move is right now. This is the intermediate term has not crossed below the long, and the long is still moving up slightly. That won't last much longer, particularly if we can't get above it before Friday. This is another 50%. So basically what's happening is on all the major indexes, we have got half of accounts in cash using Consensio. You probably heard that the move in the Dow today has erased all of the gains from earlier in the year. Now that has occurred before, but now we're almost at the end of the year. So these were the highs. So we have basically erased all of the gains from earlier in the year in the last 4 weeks. And basically 80% of those gains in the last 3 weeks. So that's as bad as it gets, folks. Okay, the Dow Jones Transportation, I said yesterday, this one made me the most nervous because what we're looking at is we're looking at half of the Dow theory really falling apart. And we are about to get a crossover probably tomorrow of the intermediate term through the long term. The long term has turned down, as we mentioned yesterday, even without the intermediate term cutting through it, because this action is so extreme that the short term and the price itself has been enough to turn the long term down. So with the other ones, I was saying 50%, I would be out of the transports entirely after this action. I wouldn't be waiting for Friday. Remembering that just as you build cash at 5, 5, 5, 10, 25, and 50 to get out of a position, you reestablish those positions if any of the lines correct in the other direction, as opposed to dumping everything with a gut feel that we're at a top and then getting all the way back in when you feel you're at a bottom. How much do you lose by being patient and doing it step by step? About 10% on a trend change. So if the trend change turns out to only be 10%, and that's basically where we are, you are going to be out of that. And if it turns around to the upside, you are going to lose out on the opportunity that you would have had if you hadn't done that. I understand that. That's the way this is designed. You want out after a 10% move in a trend change so you don't get the next 90% down. That's what it's designed to do. Okay, and lastly, we're going to look at the other real terrible situation, which is the small cap stock. This is the Russell 2000 index. We now have 4 weekly closes below the long-term average, but because we had such strength going up to the top, we have not yet turned down in terms of the long term, but notice that the intermediate term is now below it. I would be out of Russell stocks, meaning small cap stocks. Okay, that is what Consensia was saying with the big US indexes. Let's take a look at the sectors the way we did yesterday. And let's start with the consumer goods, consumer discretionary. We've got everything crossing over. We are completely negative in terms of even the long term going down. The price is below 2 of the 3. The short term is actually pulled down lower than the body of today's candle. So it's possible this is going to try some kind of a pop-up by the end of the week. But just the way this is situated, I would not be in consumer discretionary at this point. IYC is the consumer goods, which we said was holding up very well, which it did as of yesterday's posting. We did have the short term about to cross over, which it has done as of today. Intermediate term is still way up there. And the price action had not gotten down on a closing basis to the long term until today. And today the bottom dropped out of that. So this would be a 1, 2, 3, 4, at least a 25% at this point, waiting to see if it would bounce up 25% in cash, going to 50% if it can't rally and the intermediate term keeps coming down at the rate that it's doing. Each of these numbers I'm throwing out, you need to decide on your own what you're comfortable with, given what you know about your portfolio specifically. I'm just giving you what I would do and am doing for clients where I have full discretionary authority. That was the IYCs. That was consumer services. This is the energy. Again, we pointed out yesterday this triple cross all at the same time, and the bottom dropped out of this one today. So in a very short period of time, we've gone from a bull market right here up on the intermediate, up on the long, up on the intermediate, up on the short. Prices taking out the previous highs, and then 3 weeks in a row, everything is negative. And we've gone into full bear mode overnight in a 3-week period. I was very bullish back here. I had told people that as a sector rotator, I got out of technology and into energy, and it looked like that timing was perfect. We are now sitting right at the lows of the year, and basically all of that has occurred this week. So I would be out of the energy trade, and basically we would be at 50% and 100% on specifically energy sector stocks. IYG is the financials. And same thing here. Everything is below the long-term moving average. The long-term moving average is moving down. This is a bear market. I would sell financials. Healthcare. We said yesterday that it looked like this was a place you could hide, and it still basically is. You've got a 5% cash with the price going below both of these, another 5 with the intermediate term turning down, and today's price broke through the long term, and I would do at least another 5 there, so 15% looking for the next 10% to take it to 25. But so far, if you had been doing that for the past 2 weeks, meaning moving from the ones getting into the most trouble into the sectors in the least trouble, healthcare would have been a little bit of an aid to you. Cash is still my favorite asset class of all times, regardless of what markets are doing. I love sitting in cash. You don't have to worry about it. This system is designed to raise cash as quickly as possible when there's the potential of a trend change. These are the industrials. They were the ones that really did a tremendous amount of damage along with the materials. And now, after last week and the first 3 days of this week, we're quickly getting to the point where the intermediate's going to cross and the long term is turning down, which is a 50% configuration. And that's not leaving too much in the portfolio when we do this. Here's the one thing that is looking like you could be hiding there. Not only that, but actually making a little bit of money. It was up 2% today. These are the utilities. And they have just, in the last 3 days, gone to new highs, going all the way back to the end of 2017. And notice that the short term is now back above the intermediate, and all three are moving up with the price above it. This isn't a full bull market. No reason to have any cash. And these are telecommunications, which we also said was looking pretty good as of yesterday. We had broken down below the long-term moving average, and today we were down 3.5%. The intermediate is still well above, but the short term has now broken below the long term. And again, by Friday, we could be back above that long-term moving average, but there's only 2 days worth of trading hours to do that. And that's the way you have to look at all of these. If you do weekly closes like I do on a lot of the systems that I use. So it's still well above previous lows, even after all this 4 or 5 week drop. And but it's well below where it was at the beginning of the year. And if it just sits down here, we're going to end up having to raise a lot more than 25%. Okay, now we're going to take a quick look at I'm going to go right to the short funds before we go to the stocks because of what we talked about yesterday. And the first one we're going to look at is the PSQ, which is the Pro Shares Short QQQs. And you see what it did today. These are things that can be used within a portfolio without having to sell positions. I've just said raise cash, raise cash, raise cash. Now, You can raise a little bit of cash. Instead of 50%, you can do 25%, and you can put that cash into one of these things that relates more closely to the thing you just got out of. Let me explain what that means. Just as we saw these indexes dropping, this is the NASDAQ, breaking below, remember, the long-term moving average. So you would expect its inverse to be breaking above the long-term moving average, which is what it's doing this week. We were up 4.67% today. Going back very quickly to the NASDAQ, remember that number, 4.67%. The NASDAQ was down 4.4%, and the NASDAQ 100 was down 4.63. So my point is that by making a smaller sale of the asset you have and using that cash to hedge by buying its inverse means that you have locked your entire position out of the risk spectrum. You're not going to make money. You're going to make the same amount of money on your inverse that you are losing on your long position. But you can see how closely some of these move together. This is not a double or a triple leveraged fund. These are simply the ones that I pulled together to be able to indicate what you can do relative to indexes. This is the short S&P 500. The short S&P 500 today was up 3%. And when you look at the configuration, you've got the intermediate rushing up to the long and the short already above the long and the price above the long. So you can lag into these as you are lagging out of the ones from a fully invested position. You don't need to wait to put these on if you're taking something off the other side. That means you only have to take half as much off the long positions and use that cash to put on this. What I mean by that is a 25% position if you're going to take it out of the longs. So you are now 75% long, and you put that cash into one of these, you are now 25% short. That means you are 50% hedged. You can do the math very quickly yourself, but I think you see what I'm saying. Okay, this next one is the MYYs, which are the ProShares Short Mid Cap 400, up 3.41% today. Intermediate term has cut through the long term. The long term has turned up. This is fully bullish. You can be 100% in this because it's fully bullish and you're just talking about Consensio. Don't tell me what to buy. Tell me when to buy it. You wanted to buy this as it bottomed out and the short term broke through the intermediate term along with the price. And now you've been adding to it 5, 5, 5, 10, 25, 100. So you're fully in this one. Now, this doesn't need to be used as a hedge against mid-cap stocks. You can use it on its own to make money as an asset by using Consensio. So we will get into all of that when we talk on November the 3rd about portfolio construction and the difference between just randomly picking stocks and hoping for the best and using these various techniques regardless of what the markets are doing, going up, going down, or going sideways. Okay, this is the Dow 30. This one was up 2.47% today. I'm going to go back and look at the Dow because I haven't done this. The Dow was down 600 points, but I didn't look at what that percentage was. So let's just go here. Then let's go here. It was up down 2.4%, the Dow today. So the Dow Industrials, if you had those in some form in your portfolio, and you had also been trying to hedge it piece by piece, 2.4%, as opposed to 2.47% up. So you could have been completely hedged without selling all of your Dow stocks by being in this. Now, just as the Dow is doing from top to bottom, the inverse Dow still is not fully investable. We do have price above long term. We've got short term, not yet above long term, but it is above intermediate term, and the intermediate term has moved up. So this looks like approximately a 15 to a 25% position, depending on how the week closes and all that sort of stuff. You don't need to wait till the end of the week. I'm not a trader in and out of positions. I'm only looking at long-term trends. And I do that by waiting for an entire week's worth of information on a closing basis. But you need to suit the consensio analysis and the time frames to what is most suitable for you. Okay, this is the Russell 2000. We showed the Russell, and this was up 3.85% today. I won't go back and look at the Russell, but it was close, whatever that number was. What we've got here now is we've got both of the moving averages cutting through the long term. Long term has upticked slightly visually. We can break that down and make sure that it has days to go. But this is clearly going fully bullish if it's not already there. And finally, we're going to go to the small cap stocks, the one that I said, if you're in small caps, you should be out of them according to Consensio. This index was up over 2% today. The intermediate has not yet cut through the long term, but the long term has ticked up. And within hours, regardless of what happens to price, the intermediate term will be cutting up through the long term. Okay, so there are the indexes, there are the sectors, and there are the short funds. Now let's take a look at some stocks, because that's where every portfolio is made up of stocks, bonds, and cash. The kinds of liquid portfolios I'm talking about that we'll be talking about on November the 3rd, as opposed to real estate portfolios, other wealth producing portfolios, art portfolios, numismatic portfolios, or combinations of those, even gold bullion portfolios where you've actually taken possession of gold or silver. And so in your mind, they aren't liquid. Anything that is not liquid, we're not going to be talking about. We're only talking about liquid assets that, when put together, form what is called a portfolio. And it can be, as I said, what appears to be random, and we'll try to prove that to you by you sending in your stock names, or it can be predetermined by someone who, quote unquote, is an expert that has put it together in the form of a mutual fund or an ETF or a closed-end fund. And we'll tell you the differences and why and how you find out information on them and all that sort of things. Okay, let's just quickly look at the stocks. I mentioned Tesla because after hours, it's trading up at 325. This was fully bearish as of hours ago, and now the price is up here. That is what happens during earnings season. They had blowout earnings. I just wanted you to see those. We've got some people in our consulting group that have been watching Tesla. Our drop dead was 250, and we can talk about why and how at another time. We never got down there. We tweaked it on the wick down here at 248, and then all of a sudden we are up here. And that's how quickly things can turn around in stock land. It's very difficult to do the same thing in portfolio land or in index or sector land. And that's important to know because we're talking about the volatility of what happens when you take all these very volatile things and put them together in groups and then can hedge them in groups and eliminate certain sectors in the groups, all that sort of thing. This is Amazon, not good. Amazon down 6% today, 104 points. And a number of things are happening here, but of importance is we are getting very close, if not breaking down some hyperwaves in the high-tech area. We will also go into that on November the 3rd. We will use a half a dozen examples where we can tie together some of the other systems that we're using, like Consensio, in order to tell what's going on within a portfolio. Okay, Google down 5% today. You can take a look yourself. I don't need to go into the details of where you are because all the same rules apply if you're talking about a stock, a sector, an index, an industry. It doesn't matter. The rules are the same. This is Facebook. You know it's been struggling. Can anybody not tell that this is a bear market? 1, 2, 3 with price below all three, all going down. Apple down 3.4%, hanging on very well relative to everything else. Microsoft reported and was disappointing to a certain extent. That doesn't show up in this chart. It will later, but it was holding on pretty well compared to the big techs. But they got it today. And that has started the movement down. What do we have? We've got price crossing below both the intermediate and the short, short below the intermediate turned down, price now below the long term. To me, it's a 25%. I would have been stepping out of it piece by piece as each of those happen. They don't happen on the same day, except the one or two examples we looked at. It takes 3 or 4 weeks, which gives you a lot of time to think about it, take action. If you miss it on a day, you can do it the next day or the next day because it's sequential as these things build. Cisco down 3% today, now below long-term moving average. Same basic setup as what we just saw with a couple of those others, not really in danger, but some cash should be taken off. As soon as you're below the long-term moving average, you've got to be thinking about maybe there's something else coming. And then you hope that it doesn't, so you can put your money back in 5%, 5%, and all of a sudden you're fully back in again. Okay, Comcast had already turned down price touching, going slightly below the long-term moving average, intermediate term moving down. FDX, this is very important at a lot of levels. Tops below tops below tops, bottoms below bottoms below bottoms, new lows for the year, everything below the long-term moving average, everything moving down. How could that be? This is the company that moves everything from Amazon to holiday packages. All of the retailers are trying to talk up the holidays. And here this thing is going to hell in a handbasket. Intel, same thing. Netflix, pride on its big up day, which took price much, much higher and then couldn't do anything with it, and now has rolled back over. A lot of people in our group, meaning the hedge fund, the Hyperwave research group, noticed that this was a phase 4 that broke down, played this as a phase 5, played this as a phase 6, and wondered was at the top of phase 6 after the great report came out, and then you can see where it is now. The long term has not yet turned down, but this was not a good day for those hoping that Netflix is going to recover. It closed at 301, down almost 10% today, 9.4%. Square had been stellar until very recently. It's still relatively strong compared to everything else. Hasn't closed below its long-term moving average at this point. Micron Technology, adios. AT&T, adios. Earnings came out. Biomed was stellar. You see this unbelievable candle taking it to all new time highs, followed by higher highs, and then 4 weeks in a row. And now all the action begins. Piece by piece, you take it apart. Hopefully it's going to come back and you can put it back together, but you don't want it down here somewhere before you have taken action. And the one that's really the head scratcher for me is one of, Wall Street's darlings for a long, long time, BlackRock. And it speaks for itself. Back up in here, you started raising cash, raising more cash. You're saying, oh, maybe this isn't so bad. Raising more cash, completely out, and have been out ever since. Okay. I am going to click some buttons and hope for the best.
Hey, Tim, you ready for some questions?
Yes.
Although we're going on 54.
Okay. Let's do a couple of questions and then we'll close.
All right, I'm keeping you on. My video's off. I'm going to be selfish on this one. One person mentioned last vlog that they wanted us to look at oil. Now, as you know, I have a bit of a background in oil and gas financial modeling, so I always find it fascinating. And since you wanted to talk about politics today, let's talk a little bit, right? So just a little bit of background, which was interesting to me, is, crude tumbled 5% is the Saudis, right? They pledged to produce more than they can, but it's recently been posing gains. So, bad news for oil companies is they have, a history of overspending. Like, what's been interesting is just a lot of headlines in Bloomberg has been coming out about how they're just drowning in cash. So to sum up, there's a lot going on in oil and gas, in crude. We haven't looked at WTI for a while if you want to, play around. But what are your thoughts on, should we be in oil? What are you thinking about oil?
We looked at energy stocks. Can you see this?
Yep. I'm looking at BlackRock.
Okay, that's good. Let me, why don't you get me the ticker of just crude oil? I'm going to pull up the energy again to remind people what that was showing in the sectors, because the energy is the one that we talked about. Now, this isn't oil. These are energy companies. These are oil companies, gas companies, pipeline companies, drilling companies, exploration companies, all of that sort of thing. But usually when you find the price of oil doing X, then oil companies do something like X. But let's just test that. This one we said was in a full bear market. So what ticker should I use?
Let's do WTI. West Texas.
WTI. Okay. So I'm going to
I just love that there's so much about oil and gas, how it's treated, how everything happens, how politics come into play. Everybody should be following the news on this. I think it's very interesting, and especially how many cash reserves they're raising right now and the private equity piece. And Trump recently announced that they're going to start drilling in the Arctic again. Hey Ty, do you want me to ask another question and we can
no,
do
that's okay. I want to pull up this. I've got WTI, US oil. Let's just see what happens. Okay, this is crude oil. Same setup. We did break down below the long-term moving averages we had done here, touched it back here, still in an uptrend. Long-term is not in any trouble. Price is below, and the intermediate has turned down, and the short-term has turned down. So if I was in this trade, I would have 15%, thinking about 25% out of the trade. I like it as a chart because we've got bottoms above bottoms above bottoms above bottoms. Until we take these bottoms out, I would assume that the trend is going to continue. But having said that, that's my opinion from other factors, not consensio. Consensio says that you have to go 5%, 10%, 15%. And now that price is broken down here and the intermediate is turned down, I would say 25% of your position. If you had $10,000 in it, I would have $7,500 in it. And that's the way you use consensio. Now you can override it with other things. Is it in a hyperwave? Do I want to guess in what direction it's going to go because of all of that sort of thing? But right now I would be pulling back on this. Now because I know the energy stocks and the energy sector is in a full bear market, my assumption is going to be that there's a lot of interplay between the two. So I'm going to lean my raising cash here. I'm going to lean in the direction of what the overall energy sector is doing. So I might raise a little more cash. And that would be my answer.
All right, Ty. Oh, no, I'm not muted. I'm good to go. What do you think? We should call it? Let people enjoy the rest of their day?
Yeah, that's great. Why don't you just pull up one more time, if you don't mind, the subscription agreement. And let me just quickly go over for everybody what we are going to cover 3 days before the election in terms of the webinar. And here we have the webinar. Okay, hour one, we're going to do how portfolios are constructed. How and why are they different? How and why do their risks and rewards differ? How do costs, fees, and slippage affect your total returns? What are the effects of distributions? What resources are available to inform you? There, I'm going to give you a list of places that you can subscribe to, such as Morningstar, such as uh, open end, closed end ETF experts who publish information on either a weekly or a monthly or a quarterly basis that I personally subscribe to cut through a lot of the noise to be able to answer questions quickly without looking in newspapers or trying to Google it one at a time. So that's going to be the first hour, and it's going to be some theory, but a lot of details about what makes all of these portfolios different from one another, including your own private portfolios and the one that we're going to build given the stocks that you send to us in the next week or 10 days. Hour two, how do you determine which portfolios are consistent with your objectives and risk tolerance? How do you determine when to exit a portfolio, a whole portfolio, as opposed to pieces of it? How do you de-risk a portfolio? How do you build your portfolio from multiple portfolios? What are multiple portfolios? Well, if you buy 6 mutual funds and 4 ETFs and you have bought 6 stocks, you've got one portfolio, but it's made up of number of other ones. How do those go together, and how can you know that quickly and very efficiently? So if you need to change something to be more or less risky, you can do it. Hour three is which portfolios are most consistent with the current market dynamics. We're going to look at everything from hour one and hour two, but we're going to apply that to what is going on with a bull market that looks like it's quickly becoming a bear market without any real financial or economic reasons for it. And we'll explore that assumption on my part. How much of it is political and how much of it might really be financial? Bull market portfolios, bear market portfolios, what do they look like? Post-election portfolios, given various assumptions, and we'll use specific examples for all of those. How often do you trade a portfolio, into it or out of it? Adding to it, subtracting from it, putting inverse funds into it and taking them out. How often does that need to be done, depending on what your risk and reward tolerance is? What are current trends in interest rates, stock markets, economics, domestically and globally? That's all in the last hour. So it's all going to be geared to what we see vlog by vlog, day by day between now and then. So between the vlogs and my incessant tweets, they will all culminate on November 3rd, and then we will take a full hour. Now, this time around, because so many of you, a bunch of people couldn't get in to our last consensio, and some of those that did were not upset, but disappointed that they only had a week in which to go over the information we had given them. So Leah extended that to a week and a half, and then we thought about it some more. And in this seminar coming up, we're going to give everybody a full month, 30 days after we've actually done the presentation, to be able to go back through it piece by piece, take notes, send us questions, ask questions directly to us, or just be able to understand. I was told that even though I speak very slowly, we packed so much into that consensio webinar that people are breaking it down an hour at a time. And it's taken them a long time to get through it. So those are the changes we're making. We just wanted to mention that to you, and then back over to Leah.
Thank you, Ty. All right, everybody, thank you so much for watching. Yeah, the webinar will be a lot of fun. I just noticed about 35 people just wrote in, so thank you for that. So I look forward to emailing everybody back. Ty, thanks for a great one. And yes, live chat, sorry we didn't get to your questions, but I took all them down, and there's some really, really good ones. So hopefully tomorrow we'll be able to get to all of them. So Ty, thanks.
Great. Thank you very much. Good luck with this market, and we'll talk to you tomorrow.
Ciao.